Hello. Now, today I'm going to dive into, once again, how Trump has been affecting financial markets. Namely, I'll dive into the crypto arena and the recent sharp rise that we saw in some Asian currencies before finally exploring if a recession is still on the cards in the United States. Now, starting with cryptocurrencies first. From his activity on the campaign trail, we knew that Trump would be big on crypto this time round, which is a 180-degree flip from his first term. He pledged to turn the United States into the crypto capital of the planet. So have we seen any moves in pursuit of this so far in his term? And more importantly, has Trump hit any roadblocks? Now, the biggest potential policy that we've seen Trump propose is the Bitcoin National Reserve. But Trump isn't focused solely on Bitcoin. In March, he posted on Truth Social that a digital asset stockpile should also be created, which would include cryptocurrencies such as XRP, Solana, and Cardano. In Monday's episode, I discussed the role that gold and the dollar could play in a newly emerging financial system. Could Bitcoin have a role to play in this system too? A major aim of the US with a Bitcoin National Reserve is to put the 200,000 forfeited Bitcoins that the United States has confiscated from crimes to use. Typically, assets seized by the government are liquidated and property is almost always sold. But when it comes to Bitcoin, these assets have been held, and when any speculative price rises occur, the United States government benefits from this. Now, focusing on Trump's crypto activities on a more personal level, he has quite a large involvement in the sector. He controversially issued his own Trump meme coin, and the top 220 holders of the coin were invited to an exclusive dinner with the president. This immediately led to worries of corruption and conflict of interest, as one of crypto's proposed benefits of anonymity could have led insiders to pump the price of the coins, as we've seen many times before with pump and dump schemes. Trump's personal crypto pursuits led to the Democrats blocking a Senate stablecoin bill last week, also known as the Genius Act, which previously did have bipartisan support. A letter was also sent to the US Treasury in this last week from House Democrats, asking the Treasury's money laundering watchdog to hand over any suspicious activity reports that were tied to the president, specifically his actions surrounding the Trump meme coin and his blockchain project, World Liberty Finance. So with Trump's potential violation of finance laws, bribery, and securities regulations, the battle to push the US to becoming a crypto capital of the world could be more of a dream than a reality. However, in the sector in general, what can't be denied is that more Web2 companies are entering into partnerships with crypto firms. We've also seen the crypto market provided tailwinds with the positive sentiment that comes from Trump's administration. We may look to Bitcoin for general crypto market sentiment, but other coins will have immense value in this space and in the future of finance. Just this week, we also saw that Coinbase will be the first crypto stock in the S&P 500, which also boosted Bitcoin once again to above $100,000 per coin. However, as we've seen from Trump's first few months in office, even though the crypto industry does have many tailwinds behind it, Trump does seem set on imposing certain roadblocks based on his personal interest in the sector. Now, if we zoom out and take a big picture view of the cryptocurrency industry, we should focus on who a crypto boom would benefit. I mean, firstly, it benefits Trump personally. If crypto prices accelerate, then his meme coins and his blockchain company will also benefit. Trump also admitted in August 2024 that he owns between $1 and $5 million worth of Ethereum. But crypto boosts will also benefit those in Trump's voter base. Typically, crypto is seen as more of a Wild West gambling casino than actual investment assets, and any price in crypto would benefit those from lower income backgrounds who pursue such risky returns. This would have the potential to boost Trump's support generally amongst Americans. But, as I've implied in this discussion, crypto is a massively speculative industry. A forex currency doesn't fluctuate 20% in a week, but crypto does have the potential to do this. If Bitcoin or any other crypto assets did become involved in such a reserve in the United States, this would boost uncertainty. Then again, as we've seen from Trump's few months in office, perhaps uncertainty is what he wants. Moving on to the spike that we've recently seen in Asian currencies. Now, Reuters posted an article and they led with the title, Asian Crisis in Reverse. As we saw the Taiwanese dollar spike, the Hong Kong dollar tested its peg with the United States dollar, and the Singapore dollar soared close to decade highs. So, to flash back to one of my favourite books by Russell Napier, let's quickly cover what occurred in the Asian financial crisis in the 1990s. Now, the crisis was generally a sequence of currency devaluations that started in 1997 and spread quickly to other Asian nations. Thailand ended the baht's peg to the dollar after the country depleted large amounts of the country's forex reserves, trying to defend the peg with the US dollar from downward pressure. This crisis was rooted in growth policies that were encouraging high investment in Asian countries, but this was often funded via debt. After Thailand let the baht fall in value against the US dollar, the Malaysian, Filipino, and Indonesian currencies followed suit in the weeks afterwards. This crisis then also spread to South Korea. Hong Kong managed to fend off many speculative moves against its currency due to its peg to the US dollar via a currency board system that is heavily backed by US dollar reserves. But other nations in Asia who didn't at the time possess such an ample amount of dollar reserves weren't so lucky. Many of the affected nations fell into recessions, and bailouts from the IMF and the World Bank did alleviate some of this crisis. But this was a typical asset bubble because Asia was seen as the next huge area of economic growth and development, and so capital flooded into the continent. But as we see with all bubbles, they eventually burst, and this is what occurred here in the Asian financial crisis in the 1990s. So, what differences are we seeing in the currency moves that are occurring today? Well, this time around, we've seen the opposite move, seeing a sharp rise in Asian currencies. This could mark inflows heading into Asia, but it also could mark dollar selling, or both could be occurring at the same time. What effects would such moves have, and why is it happening? Now, courtesy of Louis Vincent Gave from GavCal, we do have some potential answers. Since the Asian financial crisis occurred, these countries who experienced a shortage of US dollars have been accumulating dollar savings. Rather than sitting on these savings, with them just sat there doing nothing, they're often deployed into US treasuries. However, with Trump's stock market moves and US debt currently being seen as less attractive than Greek debt, treasuries aren't being seen as attractive an asset. We also last week saw talk of potential Asian currency deals contributing to such moves, which would decrease the value of the US dollar while boosting the value of other currencies around the world. However, Taiwan came out and openly denied that this was occurring. Now, another part of the Asian currency rise could be explained by the tariffs that have negatively impacted global trade and have accelerated dollar diversification. If we see tariffs re-escalate in the future, it's well worth keeping one eye on these Asian currencies to see if dollar selling reoccurs. And even if we don't see escalation on the tariff front again, in this new financial world, the dollar hedge is no longer seen as such a safe haven as it was in the past. Nations around the world are seeking diversification, and hedging is being heavily pursued. Now, my final chapter that I want to cover today is a potential fear that some of Trump's policies could incite a recession in the United States. So what is the likelihood of this occurring, and where should we look for any early indicators that economic activity in the United States could be slowing down? Firstly, before diving into whether Trump's policies will incite a recession, let's explore some of the background first. When Trump's tariffs were first being proposed, we saw many analysts and brokerages change their odds of a recession occurring this year. Specifically, we saw JP Morgan increase odds from 40% to 60%. And then to back up that growth would potentially be slowing, in Q1, we saw a negative growth rate of 0.3% of GDP, which Trump went on to blame on Joe Biden. However, since we've seen the tariffs scaled back, especially on the China front, we've recently seen Goldman Sachs cut recession odds from 45% to 35%, and GDP estimates for the full year of 2025 were boosted from 0.5% to 1%. We've also seen S&P end-of-year predictions boosted and boosts to company earnings expectations. Now, in determining potential recession odds in the United States, the tariff rate on China is, in my opinion, the most important place to look here. Since the trade relationship between the United States and China is the most important trade relationship in the world, a breakdown here will have adverse effects on US-China bilateral trade, but will also affect global trade. This impact would also be felt negatively within the United States, as I've discussed in my recent episodes on tariffs. In industries where supply chains are interdependent, the United States is vulnerable to pain and inflationary pressures. Sectors such as semiconductors are a prime example of this, as we've discussed in recent episodes. So, yes, the level of tariffs is, of course, important, but the direction in which they are implemented is also equally important. But as we've seen, Trump's quick-fire policy decisions can quickly lead to change. Thankfully, we do have areas of financial markets where we can check for early warning signs that recession risks could be rising. One such early indicator that recession odds could be about to rise is Polymarket, which could be used as a proxy for overall market sentiment. For wider reaching impacts, copper nowadays typically acts as an indicator of Chinese economic activity. So falling copper could be an indication that Chinese economic activity is slowing down. Finally, we could also check for sector rotation within the S&P 500. If investors rotate into stocks that are necessities, such as healthcare utilities, and consumer staples. This could be an indication that investors are becoming more cautious. Even with the risk of recession dropping with lower tariffs, we're still not out of the woods yet. Risks do remain, such as potential inflationary spikes and a cooling unemployment market, as even the 10% base level tariffs that remain could impact the profitability of American firms. To attempt to divert some of the blame for this recession risk, Trump is blaming Biden, as I mentioned, but he's also shouting at the Fed chairman, Jerome Powell, on Truth Social. We did see positive CPI data for April, with prices rising 2.3% on an annual basis, but this remains above the Federal Reserve's target of 2%. Markets did respond positively, as potential rate cuts were seen as more likely due to the data, but the ball is ultimately in Jerome Powell's hands. It seems that he doesn't want to cut rates, only to then see inflationary pressures emerge from Trump's tariff policy. So he will likely wait longer, even with Trump demanding that Powell cuts rates. So looking forward, the May CPI data could provide some answers to potential directions that Jerome Powell is going to head in the future. With many companies within the United States front-running tariffs in April, and other tariffs not coming into effect until the 9th of April, at which point Trump then scaled them back, the next data, announced in May, could show more effects of Trump's tariff policy. The incredibly high tariffs against China would likely contribute to most of any inflationary pressures that emerged as a result of the tariffs. So we should also look to the May CPI data to see if such effects are represented in the data. In this last few years, Jerome Powell has made it clear that he prioritizes addressing inflation rather than lowering rates to incite economic growth. So we can also check Jerome Powell's future speeches and his general rhetoric surrounding inflation to indicate if we could get rate cuts anytime soon, which would boost economic activity. Alternatively, Powell could keep rates elevated, and Trump will have to head over to Truth Social and do more shouting. So, do you think that Jerome Powell will bend under pressure from Trump, or do you believe that he is politically independent? And also, do you think that a Bitcoin national reserve should be pursued, even with Trump's personal interests in the crypto sector? The next time, I'm going to finish covering the effects on financial markets that we've seen from Trump's first few months in office, before finally diving into longer-term effects on globalization and the global financial system. I'll then finally wrap up this section on the financial aspects of Trump's second term by discussing the potential for a Mar-a-Lago Accord. I've been Dylan. I'll talk to you next time.